This is Doug and Brian. I'm with Coldwell Banker Realty. Brian is
Guild Mortgage.
Guild Mortgage.
Yes.
But Brian is the mortgage guy. Just no question. Just
That's it.
That's it.
Yeah.
Brian, the mortgage man. Anyway, what we wanted to do today is each industry that you go into has a bunch of in the industry terminology that most people outside the industry don't have a clue. And so what we thought we'd do is go back and forth a little bit and show you guys what some of those mean, what they are and what they mean. So Brian, let's start.
Okay, ready? I've got one.
Oh, you're okay.
Let's go.
Let's go.
Yours are worse than mine. Mine makes sense.
Okay.
Okay, I want to know what this is. REPC.
Okay. So in the real estate world, you'll hear a lot of agents and brokers and stuff talking about they call it a REPC. Well, the REPC, I mean, first of all, if we had periods, that would help because it stands for Real Estate Purchase Contract.
Yes.
So that's what it is. It's the contract so if I'm buying Brian's house, I have to do a real estate contract to buy the house, which is the REPC. It's easy enough, but when in the industry you're running around going, "Hey, REPC, REPC, REPC," nobody knows. They think it's a dog.
Yeah,
So,
could be. Not
okay.
bad. Could be.
All right.
Okay.
So, all right.
Hit me.
Mortgage-wise, what is DTI?
DTI. This is an easy one, Doug. No. Okay. This stands. Okay. Periods. Remember?
Oh. Sorry.
Okay. Debt to income. What is debt to income? Well, what that is I'll do a little drawing.
Oh, okay.
So debt to income is a ratio, it's a percentage, and it's how we lenders, one of the items we use to qualify you to buy a home. Say, how much do you qualify for? Example would be if you make $5,000 per month,
Okay.
and let's say your new house payment and your car payment, everything total is $2,500 of payments, then that's 50%. So your DTI would be 50%.
Okay. So in the lending world, what do you want that number to be?
You want it to be that or less than that.
Like 42, 44, whatever that way?
Yeah, it needs to be at least, it depends on the type of loan, but it's generally 50, sometimes 55%. But it depends, it needs to be down in that area.
Okay. Perfect. All right, that's easy enough.
There you go.
We started easy. Now we got other.
I got a doozy one for you. This might stump Doug even. Ready?
Okay, let's go.
Okay, this is not an acronym. This is like a couple words. So buyer, I guess the slash, right? Broker.
Okay.
Agreement, kind of.
Yeah, kind of. So the buyer-broker agreement is what you get when you work with a real estate professional. So if I'm going to take Brian and I'm going to help Brian buy a house, then I have this buyer broker agreement with Brian, which is the agency that I have to, in the big word, fiduciary, to be able to help Brian and to do things in Brian's best interest. So what that does is I'm not going to run out and tell the people selling the house that Brian's debt to income ratio, DTI, is 50%, or that he just bought a new Corvette, or that he has, money from past generations or whatever. I don't want to disclose that because I work for Brian and I want to do what's in his best interest. So that's where this buyer broker agreement comes in, is I work for you. I'm going to do what's in your best interest. Let's go buy the house.
Yep. Okay. I like that one. That's good. That's good.
Okay. We got a little harder one for Brian.
Bring it on.
And this one it's 3 letters, but it's a 4-letter word.
Yes.
So we're going to do the PMI.
PMI. Doug, this is a great thing. This is a blessing. If we didn't have it, life wouldn't go on. That is called what's called private mortgage insurance. And mortgage insurance, that's what people call it, MI or PMI, is what you as you buy a house, I'm going to buy a house, I'm putting 10% down. If I put less than 20% down, then I have to have some form of that.
Okay.
So what it does, it's a fee it's an insurance policy that I buy as a homeowner. I pay for it, and it insures the lender against me going into default. So it insures that top part of the loan is what it does. So we love it. It's good. If it were not for PMI, these are independent companies usually that issue these policies. If it were not for these policies, every bank, every lender would require at least 20% down. So I'm going to say we're going to give it a thumbs up.
Okay.
And what it costs varies on several factors, credit and all that. But
At any point, does that just automatically drop off, or or do you have to apply to have it dropped off?
Yes, and sometimes no. It depends on the type of loan. So if you have a regular, like a conventional mortgage,
okay,
then it will drop off automatically, which can be a long time, like 9 years sometimes. Or you can actually dispute it and get it removed early, which a lot of people do that. Get it off early.
Okay.
If there's some FHA loans and other loans, it stays on for the life of the loan. But
awesome.
yes, I like that.
Okay.
Thumbs up. Okay, what should I ask you now?
Whatever.
Oh, dude, Doug, this is going to be due diligence.
And we're not being graded on spelling.
Is that, tell me, is that spelled right?
Well, which is why you'd probably just do like this, like we've been doing.
Dungeons and Dragons is my favorite game.
So due diligence is actually where we do the work of the real estate side. And this is usually where things get caught or found. And so in the due diligence side, the due diligence is like we go to the title company and check and make sure that the people selling the house are actually the right people to sell the house.
Yeah.
Because every once in a while, it's grandma's house, grandma's passed, grandson's trying to sell the house. He doesn't have a legal standing to sell the house. But so we've got to make that work,
yeah.
and that's where that due diligence comes in. Then it becomes the buyer. So their option to be able to say we're okay with the boundaries and that the neighbor's shed is over the boundary.
Yeah.
Or you can say no, we don't want the house. We're going to move on.
Now I've seen in the REPC in the contract purchase contract, I've seen a due diligence deadline.
Correct.
What does that mean?
There's 4 main deadlines in the REPC, real estate purchase contract, right? You've got your seller disclosures,
yeah,
which the seller then tells you everything that they've done to the house. Put a new roof on, the basement flooded, we fixed, repaired it, whatever.
Yeah.
Then you have the buyer's due diligence. And that's where, like we were talking about, we check boundaries, we check personal of who's selling the house, making sure everything works that way.
Like liens on the property,
liens
stuff
on
like
the
that.
property, yeah. And so like we did one of the ones that I've done. I had the buyer, and we were going to buy this house. Well, the homeowner that was selling the house had a bankruptcy. Well, most people don't understand that in a bankruptcy, the bankruptcy goes on the house and on your person, you as a person. Well, the seller had taken care of everything on the personal side, but it still had the bankruptcy attached to the house. So we found that you can't buy it in that situation because it has to be clear and clean. So we had to fix that before they could buy it.
Yep.
So anyway, due diligence, there's all kinds of stuff, and there's stories for days. I was selling a house in Nephi, and I started, the seller just happened to be there. I start talking to him, and he tells me that his house and the house next door are exactly the same because they came from the Japanese internment camp out in Delta. But on
the house itself.
the house itself.
Yeah.
But on the paperwork with the county, everything that it said the house was built in 1942 in Nephi. So not only was everything wrong, but because we were doing our due diligence, we started looking at a whole lot of other things attached to it, like how come it was raised on the foundation? How is it supported? And we go down in the crawl space, and they literally had rocks and bricks stacked up to hold the middle. So the buyers, we just left because we did our due diligence, and it was not a good thing. So
that's why we want to have Doug around, because otherwise I wouldn't have gone to the basement. The official county records showed it was built in 1942 in Nephi. Right.
Yeah, and so was the one next door. But it was built in Delta, put on a truck after World War II, trucked. And you know what? There's more than those two. I found some since then.
That is so weird.
So
that is really
anyway,
weird.
But there's all kinds of different things like that with a house.
Yeah.
You know, another one that we see a lot of in Utah is, hey, I want to buy a house with an unfinished basement because I want to finish it.
Yeah.
And then people go in and finish it, but they're not contractors. They don't get it, permitted.
Yeah.
And so now it's like, now what do we do? Because
you got some sketchy electrical down there.
Yeah.
Who did that? Well,
maybe,
I did it with my grandson, and we kind of
Yeah. We just did that.
Yeah.
So anyway, that's due diligence, and that's how due diligence works. All right.
Hit me.
Here we go. ADU. Here in Utah, we're hearing more and more and more of those three letters.
Yes, ADU. This is an accessory dwelling unit. Now, what this means is, well, I'll draw it out. Okay, so let's say this is a house. This is a sophisticated floor plan of a house, right? And let's say your front door is right here, your front door is here, and maybe you got a side door that goes down to a basement or something. So it's a single-family house. So it's one house, and maybe the upstairs, and then you have a downstairs. And an accessory dwelling unit is to say, for example, in this house, you said, okay, I could rent out my basement legally. And how do we know if it's legal, Doug?
It's zoned that way.
Yeah.
And so you've got to find out from the city in the due diligence
what the requirements are. And all the cities are different. Some cities are more difficult. Orem City, for example, you have to get your ADU approved through the city. It's not a huge deal, but the state has put a lot of pressure on these cities to loosen up a little bit. Spanish Fork's easy. South County's easy. So anyway.
And a lot of that, a lot of that depends on parking.
Yep.
Because in the winter around here, most cities want the streets cleared so that they can plow the snow. And if you've got an ADU and you've got extra cars all parked out in the street, they can't do that.
Yeah, and it's super easy to find out. I can send you the requirements of a particular city. It's really easy. So it usually deals with parking and access, like a separate, independent, whatever. So, but here's the cool thing, though. And this is very relatively recent. We weren't able to do this from the lending side as much till recently, which is I can actually use some of the income you would get from an ADU.
Woo-hoo.
So let's say, for example, Doug, let's say, for example, hey, my budget is $2,500 a month. I think I got my numbers. I hope my numbers are right. $2,500 a month will get you a house for about $380,000, something like that, right? Roughly, okay? So that's my budget. And you're saying, okay, Doug, how many homes are available for $380,000? There's some, but not a ton. Right.
And when you say homes, they're more condo or...
I don't want a condominium. I don't want a townhome. I want a single-family house with a yard.
So in Utah County, there's probably 15?
Okay, not 200.
Nope.
Yeah, exactly. So that's there. But if let's say, what would a normal single-family house rent the basement for? Just give me a number. $900 maybe?
$900,000, yeah.
$900. Okay. So if I got $900 from this downstairs unit every month, right? From a renter?
So go ahead. I'm going to just put our stairs in.
There we go. Now we're talking. So I rent it for $900. Now, I'm going to add $900 to this, and this gets me to about $3,400 a month. Oh. Well, sometimes you get $9,000. Yes. So $3,400. That gets you about a $500,000 house. How many homes are for sale at $500,000 price range?
There's a lot.
A lot. And that opens it up. So that's really not a bad way to go. And we've actually done some of them where you find a cheaper house at $400,000 range or something like this, even with an ADU, even better.
Now, with an ADU, does it going back to our drawing? If you don't have a basement and you have a big lot, can't you put like a barn dominium or something in the backyard and have that be the same thing?
Yep. Yeah. In fact, and this is part of goes back to the due diligence. We've seen those properties, and Doug will go in and make sure that ADU, which is a detached, they call it, not attached to the house, is legal. You can't just build it. You got to get permission from the city and permits and all that stuff. But the nice thing about these ADUs, in most, I think all cities now, you do not have to have separate meters and separate furnaces and separate, like they used to say, all that. So that's pretty cool. Now, what an ADU is not, it's not a duplex, a 2-unit. So an ADU, we take this house here, and let's say it's actually right down here, and you got another doorway. It's completely separate.
Okay.
So you got unit A and B. That would be a duplex. That's not what this is. But that's a whole different thing.
So with this and doing this, you have to live in it.
That's right. You have to live in it to count any of the income to help you qualify for the mortgage. Now, when you buy this house, you don't have to have it rented out. The appraiser will say, okay, ADUs in a house this size, they rent for about $900. That's the number I can use.
Okay.
Basically. Yep.
Nice.
I like it. And this is a new thing. And the cities are getting on board now. Finally.
Sweet.
Finally.
Okay.
Okay. I need a term. Let's see. What's a good one? Oh, this may be the best term ever.
All right. Go for it.
Okay. I'm going to give you a couple. So there's settlement. I'm going to call it also, well, you give me the AKAs. What are some other words for the word settlement?
Okay. So settlement is what happened when Christopher Columbus came at...
I knew he was going to say that. What year? 1491?
1492.
Oh, when
he sailed the ocean blue.
Well, in terms of time zone you're going off of. Yeah. That's right.
All right. So settlement is where we sit down at the table. Everything is done. Due diligence is done. Brian's got the financial side done. And just real quick on that, that's why we work as a team, is because I don't want to know what your credit score is. I don't want to know how much you make. I don't want to be chasing down who you work for. That's all Brian. Brian doesn't want to know about the house. He doesn't want to know what it looks like, if it needs painted. He doesn't want to know that kind of stuff. But then we have the appraiser and the title people and the home inspectors. All of those people work as a team. And once all of that stuff is done, we sit down at the table, me and Brian and the title people and the buyers or sellers, whichever. We sit down and have a settlement. And that settlement, real simply, is just where we settle the numbers.
Yeah.
It's like, okay, Brian brings in, a stack of trees like this.
Yes.
And it's like, people get our carpal tunnel signing so many times. But you settle all of the financials and agree to, yes, this is what we agreed to. This is the purchase price. This is that. Here's everything. Everything's good. Great. And so usually in the settlement, there's probably 20 pages that actually count. All the rest of them are duplicates or cover my butt or whatever, signatures. But so anyway, but settlement, after you sign everything, does not mean here's the keys.
Oh, so settlement is okay.
Does not mean that.
So we're sitting down at the table. We've signed all our loan documents.
Yep.
Where's my keys?
Great. Shake your hand. Yeah. Great. Nice to know you. But that's where I come back into it, and Brian comes into it too, because once everything gets transferred, all the monies, everybody's agreed to it, signed it. Now all the money has to transfer. And so the mortgage person has to transfer the money from the buyer's account to the seller's account, or the seller's,
Yeah.
so that way everybody gets paid, all the money gets moved.
So I'm a buyer. I've signed all my documents.
Uh-huh.
I've got to get the money from the lender and take it to the seller, right?
No,
Oh.
all of that stuff gets taken care of by our title company.
Yes.
And it moves back and forth. So typically, when that happens, there's another term that is called recording or recorded. So what happens is you sign the paperwork, everybody goes their separate ways, and then when everything's been transferred back and forth, one of the final things that it does is it goes to the county, and the county then records that Brian is the new owner of this house.
Right.
As soon as that happens, then the title gives me a call and says, we're recorded, everything's funded. So it's funded and recorded. So everything's paid, everything's moved, and now we're recorded, so it's now your house.
So all of that, but as a buyer, all of that gets distilled down to Doug says, I'll call you at 3 with your keys.
Correct.
And all the other stuff just happens in the background. It's remarkable.
Yes, and it's an amazing thing.
Yeah.
Now, with that, like Brian just mentioned, 3 o'clock. So 3 o'clock is usually the deadline for wire transfers to go back and forth. And so if you want to close and record on the house and move in on the weekend, you don't want to do that Friday at 2:30.
Yeah.
It doesn't work. And matter of fact, I don't ever close on a Friday.
Yeah.
And so I always like to try to close on a Thursday. So that way
Friday should be get your keys day.
Well,
or earlier.
Not only that, but there are some counties that aren't even open.
Oh, that's right, the 4-day work week.
Yeah, the 4-day work week, and so they're not open. They're not going to do it anyway. So you want to be able to do settlement in the morning, usually earlier the better.
Yeah.
And then that way, all of this stuff can get recorded that day, hopefully. Or if not, we have a day cushion that happens. Then that way, you get the keys.
Love it.
So
easy.
How's that for a lot? But
the buyer, I'm the home buyer. I don't have to deal with 90% of what you just told me, right?
97% of what.
Yeah, but if you want to go at your own, I say I don't want no Doug. I don't need no Doug. Then I'll just do it all myself, and I can arrange for all that, right?
You can give it a shot. Give it a shot.
It'll work out great.
Yeah. So
okay, hit me.
Hit you. Okay. Okay. Brian came in. He was real excited about this one, so we're gonna do this one. GSA.
Okay. This one is. I should use the green pen, huh? Green, smart, advantage. I almost forgot. Green, smart, advantage. This is awesome. And it's been around for a while, but I don't think people don't know how to do it that well. What this is simply saying is this. I'm going to buy that house, maybe with the ADU even, I don't know. And it allows me, there's a lot of, coming out of Washington, your illustrious leaders have encouraged green homes, energy efficient appliances in particular is what this is aimed at. So let's say, Doug, I'm buying a house for $400,000. Maybe it was built in 1942, and all the appliances are
Delta?
In Delta, or in Nephi. And it was built, it was an older home, and I've got 30-year-old appliances. Don't like them. I want an induction range top for clean cooking. So I'll say, okay, I want to get a new range. I want a new washer and dryer. And what else would I want to get?
Probably a new fridge.
Oh, new fridge, yes, sir.
Because you need the water and the ice coming out of the door.
Yeah, I need some water. And the fridge that's in the house now, if it falls over, will die. So
there you go.
Yeah, fridge, and maybe you want to get a new thermostat
or an AC unit.
Yeah,
because the old one has the Freon in it.
Yeah. Oh yeah. A new heating system, HVAC they call that.
Yeah.
So that kind of stuff. As long as everything is viewed as energy efficient, all appliances made now are energy efficient. I don't think they make them not that way anymore. So what we can do is let's say what's all that going to cost? Let's say $20,000, right?
Sure.
Okay. So what I do is I'm going to say I can't lend you any more money than you're buying the house for, right? So I said, well, wait a minute. What if we do this? What if I pretend that you're buying the house for $420,000, and we take that $20,000 and pay for all of this stuff? So you go, and we actually have a deal with Home Depot nationally. So you just go to Home Depot. You don't need a contractor. You don't need anything. You just go to Home Depot and say, I want these 5 things. And they go, cool. And they come up with an estimate for you. And they say, boom, we'll take care of it. We include that in our loan file. We add the money, boom, and the $20,000. They deliver all the stuff, and we pay them, and you're done. So your loan, you actually are borrowing more than this. You're borrowing it as if you bought the house for $420,000. And you don't have to, the seller doesn't need to be involved. The seller doesn't have to buy this stuff like we used to.
Mm-hmm.
Now it's just easy, butter.
All right, cool.
Okay, another term. What's a good term?
The last one, that CMA one.
Oh, this is fantastic. CMA. That's CNA is the nursing assistant.
Yeah, CNA is
CMA.
Okay. So in the real estate world, in the appraisal world, everything that comes down to this is the terminology of it. But it's comparative market analysis.
Why would he want one of those?
Well, because we're selling Brian's house, we take a look at the square footage, the age of the house, and we compare that to other ones in the neighborhood that have sold or are for sale, so that we can get an accurate price on the house and what it's worth.
So when my neighbor says, hey, dude, the guy down the street just sold his house for $500,000. I go to Doug and say, Doug, that guy down the street just sold his house for $500,000. And you look into it and determine what?
No, don't listen to them. No.
Anyway. Neighbors, by the way, secret between the 3 of us, neighbors kind of
Yeah, they overinflate. They don't know,
You mean 450, right?
Yeah.
Oh, okay.
Yeah. So yeah, but that's what we do is we go look at it. We say, here's the dollar figure.
The actual dollar figure.
The actual dollar figure. And so in a perfect scenario, where what you like to do is you like to have when we're selling your house, we've done a great market analysis and priced it exactly right, so that way when the appraiser comes in, because the appraiser is going to come from the mortgage side, and he's going to say, yes, that's the house values at this, so yes, we can loan that dollar amount on that property. And so if I've done my job and done it right with putting a price on the house, the appraiser is going to come in, it'll match everybody, everything's nice and smooth.
Right.
But if, like Brian said, the neighbor's saying that his sold for X, and so he's like, oh, well, I think instead of 500, we should be at 600. And it's like, there's lots of brand new real estate agents that'll be like, woohoo, yeah, I'll do it for 6.
Or neighbors that lie. Yeah. Just saying.
Just saying. Anyway, but they'll come in and do what they call buy the listing for 6. But what's going to happen is it's not accurate, and is because all the realtors that are going to show that, or if somebody wants to buy it, the first thing they're going to do is do a market analysis. They're going to say, hey, it's worth 5, it's not worth 6. What are you doing? And it'll either sit there and then you'll watch the price come down and down and down and down and down until it hits market, or they'll just get tired of each other and they call it expire. So it'll expire off the market. So your market analysis and being able to compare is really important.
Yeah, it's not that easy, because all houses are different.
100%.
And there's different size yards and condition and.
Well, and again, there's all kinds of different stories that go, with that, because I had one big Victorian house, a beautiful house, but there was nothing to compare it to.
Right.
It was in Payson, and I mean they went trying to.
I remember that one.
Yeah, I mean it was a beautiful home.
Yeah.
But there was nothing, and so the appraiser came in, and he's like, "There is nothing." And so what he did is he deleted the basement. Just said, "I can't." So I'm going to do everything above grade and compare the above grade, so not the basement.
Yeah.
But the basement had a mother-in-law apartment. It had a full kitchen.
It's the greatest basement
it had
ever.
all kinds of stuff in the basement that they didn't get any credit for. But yet, on the sale price, it has to tie in there somehow.
It has value. It's just it's hard to prove the value. That's where these get really difficult.
Correct.
Yeah.
So anyway, market analysis, and even with those market analysis and just dealing with appraisers sometimes, if you're in like Sanpete County, you really want to have people that specialize in Sanpete County because they know these values. You want somebody that's going to specialize in Lehigh proper.
Yeah.
Having somebody that's a real estate agent from Ogden that's going to help somebody in Vernal, yes, you can do it, but it's not going to be that good because they don't know the market.
Yeah. And there's a lot of sales that are you just have to know about. There's no official record of them, especially in Utah. We don't just tell the government what we sell houses for. So that can be gnarly.
Yeah.
Yeah. I like it.
All right. So on the real estate side, that's kind of a bunch of it. We got one more for Brian.
Let's go.
All right. So we're going to do the VLP.
IP. Yeah. I know that one. Okay. There are a couple different versions of this. There's also LIP, LIP, I like to call it. I just made that up, actually. I guess it is LIP.
There you go.
And then there's MIP.
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 Lip and MIP.
Lip, and MIP. What these are relatively new distinctions. The federal government has made great strides and efforts to help moderate income individuals buy homes nationwide. And it's had effect. It's had an effect here in Utah, in particular, because of our prices. It's helped a lot. This means very low income purchase. It's a designation of a type of mortgage, or a feature of a mortgage. So very low income purchase. This is a low income purchase and a moderate income purchase. So, for example, we use these average median income numbers and all that. I won't go into that. But this is the lower of the three income levels. So kind of an income level 1, 2, and 3. These ones offer concessions from these federal agencies that will give you money. For example, if you qualify under the VLIP, then you get $2,500 towards your costs. Just here you go.
Like toward closing costs?
Yeah, towards closing costs. And
Okay.
it's just a grant. It's a grant from Freddie Mac, actually, this one. But it's one of the agencies. They give you the money. So you're $2,500 cheaper than a guy, the same person, not using that program. And it's just a regular conventional loan. Rates are just as good as anybody else. The low income one does not have that, but it does have a reduced PMI. So your PMI is lower than it would be.
Do you guys remember what that one is? PMI?
Yes, quiz.
Yep.
The mortgage insurance is cheaper. And then this one's pretty normal. It's a little cheaper, but it's about the same. So, but here's what all these do. This is a guild mortgage thing. We are all, if you qualify for one of these, even the higher one, you get a Home Depot gift card. After settlement, we're using these sentences. So after settlement, you get a Home Depot gift card for $2,000, and you can use it however you want.
Nice.
That's just a gift from us. So we're seeing a lot more of this stuff. Very helpful.
So with this is all income based. This does not go into credit scores.
Correct. Had nothing to do with credit.
So somebody that's got a 200 credit score is not going to qualify for VLIP.
Correct. This doesn't help. Yeah, it doesn't help. So if you have your credit scores are too low to qualify for anything, for example.
If you can't buy a candy bar at 7-Eleven.
Yes. Then these aren't going to help you.
Okay.
So it doesn't give a break on credit. It's really designed to help keep your payment down. See, this also has lower PMI, by the way. plus the money. So so it really is designed to keep your payment down the best we can and give you a little bit of a help on the closing costs.
Nice.
Not bad.
Well, so there you go. Now you understand some of the terminology that you hear from within our industry. So hopefully that helps and
Yeah.
makes you more educated.
Very good.